Imagine waking up tomorrow and realizing that the money in your bank account doesn't actually exist. Not in the vault, not in cash, not even in some digital vault guarded by lasers and passwords. It exists only as a number on a screen, a promise, a belief, a collective illusion. If everyone went to their bank at once to withdraw their money, the entire system would collapse in a single afternoon. That's not a conspiracy theory. That's how the system is designed. It's called fractional reserve banking, and it's the quiet trick that turned debt into wealth for some and illusion into stability for everyone else. In the beginning, money was simple. It was something you could hold, weigh, and trust: gold, silver, copper. In medieval Europe, merchants and nobles stored their gold with goldsmiths, who offered to keep it safe. In exchange, they issued paper receipts, promissory notes that proved ownership. At first, those notes were convenient stand-ins for real gold. But soon, goldsmiths noticed something curious. People rarely came back for their gold. They traded the receipts among themselves instead. And if the paper itself was being treated as real money, why not issue more of it than there was gold in the vault? So they did. And just like that, the first bankers discovered alchemy, turning promises into profit. Those extra receipts, backed by nothing but faith, earned interest, funded wars, and expanded trade. But every expansion came with a risk. What if too many people wanted their gold back? Every time that happened, every bank run, the illusion cracked. And to preserve it, governments stepped in to protect not the people, but the system. The trick became institutionalized. In 1694, the Bank of England was born not to serve the public, but to fund the crown's debts. The king borrowed vast sums created from thin air, and taxpayers were left to pay interest on money that never existed. It was the same magic the goldsmiths had used, only now it had royal approval. Over time, central banks replaced vaults. Paper replaced metal. And the illusion became the foundation of global finance. By the 20th century, the principle of fractional banking had conquered the world. A commercial bank no longer needed to keep $1 for every dollar it promised. Instead, it could hold only a fraction, say 10%, and lend out the rest. Each loan created new money that didn't exist before. When you borrow to buy a house, that money isn't taken from someone else's account. It's created the moment your signature hits the paper. In 2020, the system evolved again. The Federal Reserve dropped reserve requirements to 0%. In other words, banks no longer needed to hold any physical reserves at all. They could lend infinitely, limited only by their confidence and regulation. The illusion had become complete. So what does that mean? It means more than 90% of all the money in the world doesn't exist as cash. It's a digital promise, born as debt, sustained by belief. Every dollar, every euro, every yen is someone's IOU owed back with interest. But here's the catch. The system creates the debt, not the money to pay the interest. That means there is always more debt than money, and someone must lose for the rest to win. When times are good, loans flow, and the illusion expands. When fear spreads, loans stop, money evaporates, and crises begin. Every financial collapse from the Great Depression to 2008 is a crisis of confidence. It's not the money that disappears. It's the trust. To keep that trust alive, global regulators introduced rules like the Basel Accords. They were meant to limit how much risk banks could take. In theory, banks must hold a certain amount of real capital to back their loans. In practice, clever accounting and complex derivatives turned those rules into another layer of illusion. The risk didn't vanish. It was simply disguised. Banks package debts into securities, sell them, and use the proceeds to make even more loans. Each cycle inflates the total supply of money and the total burden of debt. The result is a global economy built on credit expansion. When it grows, it feels like prosperity. When it stops, it feels like collapse. That's why modern governments fear deflation more than anything else. Because deflation means the illusion is shrinking, and with it, their power. Think about what that means in your daily life. When you deposit $1,000 into your account, the bank doesn't lock it in a vault. It lends $900 of it to someone else, who then deposits that money into another bank, which lends out $810 of it again. The cycle repeats dozens of times. From one original deposit, tens of thousands of dollars are created, all owed back with interest. That's not money multiplying, that's debt compounding. It's a game of musical chairs, and as long as not everyone asks for their chair at once, the music plays. But if the music ever stops, the illusion shatters. That's what happened in 1929, and in 2008, and it will happen again. Governments are not outside this system, they are its greatest beneficiaries. They borrow money that never existed, spend it into circulation, and tax citizens to pay the interest. The cycle rewards those closest to money creation, banks, corporations, asset holders, while punishing those furthest away. When inflation hits, it erodes wages but inflates asset prices. The rich grow richer by owning the system. The working class pays by believing in it. This is the invisible architecture of power. Debt is not just an instrument, it's a control mechanism. It keeps societies in motion, economies dependent, and citizens obedient. You must keep working, not just to live, but to pay for money that was never real in the first place. Some call it stability, but it's really a treadmill running faster and faster to stay in the same place. Because inflation is not an accident, it's built into the design. Without it, the debt pyramid would collapse under its own weight. To sustain growth, new debt must always exceed the old. That's why economies celebrate growth, not in real productivity, but in borrowing. A society that stops borrowing stops growing. And when growth stops, panic begins. The illusion is fragile, but it's protected by language. They don't call it money creation from nothing. They call it quantitative easing. They don't say, your savings are being diluted. They say, stimulating the economy. They don't admit that the debt can never truly be repaid. They just raise the ceiling and call it sustainability. Every empire that played this game believed it could control the illusion forever. Rome debased its silver, France printed its assignats, Weimar Germany flooded the streets with marks. Each time, the pattern was the same: expansion, inflation, collapse. Each time, those at the top survived, and those at the bottom paid. Today, the empire is digital. Money exists as numbers flickering across screens, zeros and ones stored on servers. We no longer mint coins, we mint credit. The alchemy remains, only the symbols have changed. But there's one element that hasn't changed in thousands of years: trust. It's the invisible foundation of every currency, every contract, every civilization. Once trust breaks, the illusion dies. When people stop believing that the system will honor their balance tomorrow, the system ends no matter how sophisticated the code or how shiny the cards. That's why every central banker, every politician, and every financier speaks the same mantra: trust the system. Because if you don't, it collapses. So, where does that leave you? It means your money is not a store of value. It's a claim on a system that requires constant expansion to survive. It means your savings exist only as long as confidence does. And it means real wealth is not what sits in your account. It's what you can hold, build, or control outside of the illusion. Land, skills, knowledge, assets that cannot be printed or erased. Those have always been the true forms of wealth, long before banking tricks turned trust into currency and debt into profit. Fractional banking is the oldest magic still in use. It turns nothing into something, belief into balance sheets, and promises into power. It keeps nations running and citizens dreaming. But like every illusion, it depends on one thing that you never look too closely. Because once you do, the trick disappears.